2023, the Social Security Administration released a figure that most Americans never saw and most financial advisors never mentioned. Of the 3.4 million people who claimed Social Security benefits that year, an estimated 72% claimed either too early or without a coordinated income strategy. The result? A lifetime shortfall, per person, of between $50,000 and $182,000 in lost guaranteed income. That is not a rounding error. That is not a marginal difference. That is the difference between a retirement that works and a retirement that quietly fails you in your 70s and 80s, when you no longer have the ability, the energy, or the time to recover. And what makes this particularly troubling is that almost none of these people believed they were making a mistake. They simply did not know what they did not know. Curiosity gap. The 10% who got it right. But not everyone lost. A small group of retirees, roughly 1 in 10, walked away from the Social Security decision with something the majority did not have: a structural advantage. They did not get lucky. They did not have higher incomes or better health. What they had was access to a specific way of thinking about the claiming decision, one that goes well beyond simply picking an age and pressing submit. These are ordinary people, teachers, nurses, engineers, small business owners, who simply understood a set of rules that the majority of retirees are never shown. Hidden system. Introduction. What these retirees understood is that Social Security is not simply a benefit. It is a complex, multi-layered income system, one governed by rules around timing, spousal coordination, tax exposure, Medicare interaction, and long-term income sequencing. The Social Security Administration publishes over 2,700 separate rules governing how benefits are calculated, reduced, increased, and taxed. And yet, the average American spends fewer than 12 hours researching the claiming decision before they file. The people who come out ahead are not spending more time. They are using a structured system, a framework built around 5 specific decision points that, when coordinated correctly, can add tens of thousands of dollars in lifetime income with 0 additional risk and 0 additional investment. That system is what I want to show you today. Modern relevance, 2025-2026 context. This conversation has never been more urgent than it is right now. In 2025, the Social Security Trust Fund is projected to reach a point where, without congressional action, benefits could be reduced by approximately 17 to 23% as early as the mid-2030s. Inflation, which averaged 4.1% annually between 2021 and 2024, has permanently reset the cost of living baseline for millions of retirees. And Medicare Part B premiums, which are deducted directly from Social Security checks, increased again in 2025, quietly eroding the income that millions of people planned around. The environment in which you are making this decision is fundamentally different from the one your parents navigated. The stakes are higher, the variables are more complex, and the margin for error is smaller. This is not the moment to make a casual decision. Promise section. What you will learn. In this video, I am going to show you exactly how the Social Security decision becomes a structured income strategy rather than a guess. You will understand why claiming at 62 is the right decision for some people and a catastrophic mistake for others. You will see how married couples can coordinate their benefits to generate significantly more lifetime income than either spouse claiming independently. You will learn which income sources trigger Social Security taxation and how to sequence your withdrawals to minimize that exposure. And you will see 3 real-life case studies of people who either got this right or got it dangerously wrong. Authority positioning. I have spent over 19 years working directly with pre-retirees and retirees on the specific intersection of income planning, Social Security optimization, and tax management. In that time, I have reviewed hundreds of claiming decisions, some that added over $100,000 in lifetime income through strategic coordination, and others where a single filing choice locked someone into a permanent income reduction they never recovered from. What I am sharing with you today is not theory. It is drawn from the patterns I have seen repeated across income levels, across family structures, and across market cycles. Story blocks. 3 real-life cases. Robert H., 68, Pensacola, Florida. Retired electrician. Claimed at 62. Robert retired at 61 after a back injury. He filed for Social Security at 62 because he needed income immediately, and because, as he later told me, he was afraid he might not live long enough to benefit from waiting. His benefit at 62 was $1,640 per month. Had he waited until 67, his full retirement age, that number would have been $2,310. Had he waited until 70, it would have been $2,870. Robert is now 68 and in good health. Over the 6 years since he filed, he has received approximately $118,000 in Social Security income. Had he structured a bridge strategy using a modest IRA withdrawal to delay filing until 67, he would have received approximately $83,000 during those 5 waiting years from his own savings. But from age 67 onward, the higher benefit would have caught up and surpassed that number by age 73. Robert is 68. He has, statistically, another 18 years of life ahead of him. The permanent reduction he locked in at 62 will cost him, in present value terms, roughly $94,000 over his remaining lifetime. He did not make a bad decision. He made an uninformed one. And there is a significant difference. Margaret and Leonard T., 67 and 69, Naperville, Illinois. Retired teacher and engineer. Coordinated strategy. Margaret and Leonard came to me 18 months before Leonard's 70th birthday. Leonard had a strong earnings record. His benefit at 70 would be $3,480 per month. Margaret's benefit at her full retirement age of 67 would be $1,240 per month. A typical advisor would have told them both to wait as long as possible and file independently. Instead, we coordinated. Margaret filed at 67, drawing her own benefit immediately. Leonard delayed until 70, maximizing his monthly amount, and critically, maximizing the survivor benefit, because when Leonard passes, Margaret is entitled to his full benefit in place of her own. By filing in this coordinated sequence, their combined lifetime income modeled across both life expectancies is projected to exceed their uncoordinated alternative by $147,000. That is not a speculative number. It is arithmetic. Donna W., 71, Phoenix, Arizona. Retired nurse, tax exposure case. Donna waited until 70 to claim a smart decision on its own. Her monthly benefit was $2,960, but Donna also had a traditional IRA with $480,000 in it, and she began taking required minimum distributions at 72. The combination of her Social Security income, her RMD, and a small pension pushed her combined income above the threshold where 85% of her Social Security benefit became taxable. She had done everything right with her claiming age and unknowingly created a tax problem that will cost her approximately $9,400 per year in unnecessary federal tax for the rest of her life. Had Donna converted a portion of her IRA to a Roth in the years between 67 and 70 before her Social Security began, she could have reduced her future RMDs, kept her combined income below the taxation threshold, and preserved significantly more of her monthly benefit. The claiming decision was sound. The sequencing strategy around it was missing. For these outcomes is not financial sophistication. It is structure. The retirees who optimize their Social Security decisions are using a framework that addresses 4 distinct layers, and all 4 must be evaluated together, not independently. Missing even one of them is how the $50,000 mistakes happen. The 4-layer Social Security decision framework. The break-even analysis. Calculating the precise age at which delayed claiming mathematically surpasses early claiming, adjusted for your health, your liquid assets, and your other income sources. This is not one number. It is a range, and your personal position within that range determines everything. 2. Spousal and survivor coordination. The highest earner's benefit does not just affect that individual. It sets the survivor benefit floor for the surviving spouse. In most married households, failing to maximize the higher benefit is the single most expensive mistake a couple can make. Tax exposure mapping. Up to 85% of your Social Security benefit can be subject to federal income tax, depending on your combined income. Understanding which income sources trigger that exposure and sequencing your withdrawals to minimize it can preserve $6,000 to $14,000 per year in after-tax income. 4. Medicare and IRMA integration. Higher income in your early retirement years can trigger Medicare surcharges that reduce your net Social Security check by hundreds of dollars per month. This layer coordinates your income strategy with your Medicare premium calculation to prevent avoidable premium penalties. Step-by-step breakdown. Layer 1. The break-even analysis is where most retirees stop. They calculate the age at which delayed benefits overtake early benefits and then treat that as the answer. But the break-even age alone is incomplete. It does not account for opportunity cost, the investment return you could have earned on the difference. It does not account for your health history or family longevity. And it does not account for the bridge strategy, whether you have other liquid assets that could fund your income in the waiting years, eliminating the need to claim early for cash flow purposes alone. When all three of those factors are incorporated, the calculus changes for many people, sometimes dramatically. Layer 2, spousal coordination, is where the largest dollar amounts are typically at stake. The key insight is this. In most married households, the goal is not to maximize each spouse's benefit individually. The goal is to maximize the household's combined lifetime income stream, including the survivor period, which can last 15 to 20 years after the first spouse passes. The lower earner filing first, combined with the higher earner delaying to 70, is a strategy that frequently adds 6 figures in lifetime household income. And yet fewer than 12% of married couples coordinate their claims with this structure. Layer 3 addresses taxation. The IRS uses what is called combined income, your adjusted gross income, plus non-taxable interest, plus half of your Social Security benefit, to determine how much of your benefit is taxable. If that combined number exceeds $34,000 for a single filer, or $44,000 for a couple, up to 85% of your Social Security can be taxed as ordinary income. The strategic solution often involves converting traditional IRA balances to Roth in the years before your benefit begins, reducing future RMDs, reducing combined income, and preserving more of your monthly check in the years when it matters most. Layer 4. The Medicare interaction is the one most people discover only after it is too late. Medicare Part B and Part D premiums are determined by your income from 2 years prior. If your income in 2023 was above $103,000 as an individual, you are already paying elevated 2025 Medicare premiums, and those premiums are deducted directly from your Social Security check before you ever receive it. Proper income management in the years leading up to Medicare enrollment can prevent these surcharges entirely. Failure examples. When the system goes wrong. I want to be direct about one thing. This framework, applied incorrectly, can cause damage. A single filer with a serious health condition who delays to 70 based on a break-even analysis that assumes average life expectancy may claim a benefit they never fully collect. The system only works when the inputs are honest and personalized. A 63-year-old with no liquid assets, no pension, and $180,000 in a traditional IRA should not necessarily delay to 70 just because a calculator says the break-even age is 77. The financial and psychological cost of the bridge period must be weighed carefully. The single most expensive mistake is applying a general rule to a specific life. Bonus insight. The Roth conversion window. For those of you who are between the ages of 60 and 69 and have not yet claimed, there is a strategic window available to you that closes the moment your Social Security income begins. It is called the Roth conversion window. In the years before you file, your taxable income is typically at its lowest point in your adult life, lower than your working years, lower than your years with RMDs. This creates an opportunity to convert traditional IRA funds to Roth at a lower marginal rate, permanently reducing your future required minimum distributions, reducing your future combined income, and in many cases, pulling your future Social Security benefit entirely out of the taxable zone. The window is finite. Once your benefit begins, the income landscape changes, and the opportunity shrinks or disappears entirely. Soft monetization. Free resource. If you want to apply this framework to your own situation, I have put together a detailed checklist, the Social Security Decision Audit, that walks you through all 4 layers, with the specific questions you need to answer before you file. It is available in the description below at no cost. It is not a sales document. It is a structured tool that will help you see exactly where your current plan has gaps and what to do about them. Conclusion. It is not luck. It is structure. What I want you to take from this video is simple. The retirees who maximize their Social Security income are not lucky. They are not wealthier. They are not smarter. They are structured. They made a decision that most people treat as a one-time administrative task, and they treated it as what it actually is, the most consequential financial decision of their retirement. The difference between a well-structured claim and an uninformed one is not a small number. It is, in many cases, the difference between financial security in your 80s and financial anxiety. You now know the framework. What you do with it is up to you. Call to action. If this gave you something useful, if it clarified something you had been uncertain about, or raised a question you had not thought to ask, then subscribe to this channel. Every week we publish clear, detailed content on retirement income, Social Security strategy, and tax management for people approaching or in retirement. No noise, no sales pressure, just structure. I will see you in the next one.